Good afternoon. I'm Jeff Frieden. I'm professor of international and public affairs here at Columbia University and its School of International and Public Affairs, and in the Department of Political Science here. And it is my very great pleasure today to be introducing and moderating this IGP panel on tariffs and their implications. The Institute of Global Politics is housed at Columbia University's School of International and Public Affairs. It produces cutting-edge research to support policymaking and others seeking to advance innovative, evidence-based solutions to pressing global challenges. This is an event of the Institute of Global Politics. Welcome to everyone. Over the last 3 months, the international economic order and the international trading system have been thrown into what can only be called disarray by the trade policies of the new second Trump administration. First, the acceleration of an escalation of the trade war with China, imposition of additional tariffs on a number of other countries, including some traditional American allies, and as of April 2nd, the announcement of a series of what have been called reciprocal tariffs on virtually every country in the world and some places that actually aren't countries. We have a fantastic panel today to walk us through what's going on in the international trading system and to talk a little bit about the implications of the new trade policies of the Trump administration. I'm going to first introduce the members of the panel, then turn to them one by one for some opening remarks, after which we'll have a discussion among the panelists, and then, as time allowing, go to some questions that have been submitted by people in the audience. I'm looking forward to a very enlightening discussion, and I'm hopeful that you will enjoy and learn from our conversation here today. So we have a great group of scholars to talk, and some practitioners and former practitioners to talk about this topic. We're going to start with David Weinstein, who is the Carl Shoup Professor of the Japanese Economy here at Columbia University. He's the director of the Center on Japanese Economy and Business and a research associate of the National Bureau of Economic Research. Following hearing from David, we'll hear from Jacob Liu, who is a professor of international and public affairs here at SIPA at Columbia University. He is a former Secretary of the Treasury of the United States and a former U.S. ambassador to Israel. Then we'll hear from Teresa Fort, who is professor of business administration at the Tuck School of Business at Dartmouth, a research affiliate of the Center for Economic Policy Research in London, and a faculty research fellow of the National Bureau of Economic Research here in the United States in Cambridge. And then finally, for a view from overseas, we have Dennis Novi, who is a professor of economics at the University of Warwick in England, the impact director of the Center for Competitive Advantage in the Global Economy, and a research fellow of the Center for Economic Policy Research in London. So let's start with David, giving us some sense, I hope, David, that you will be able to give us some sense of how you see the general nature and goals of the Trump administration's trade policy, both as it has been announced and as it has been in the process of implementation over the past couple of months. David, go ahead.
Okay, thanks very much. It's been a very busy couple months. I think the best way to portray what the Trump administration is trying to do is that it views bilateral trade deficits as a measure of the barriers that U.S. exporters face. So in their thinking, if the U.S. is running a trade deficit with China, then that implies that U.S. firms are facing greater restrictions in the Chinese market than Chinese exporters are facing in the U.S. market. And this idea rose to prominence in the 1980s when many Americans saw Japan's large trade deficits as a strong indicator of that country's closed markets. And in fact, Donald Trump took out full-page ads in the New York Times in the 1980s, making exactly this point and linking the trade deficits to defense commitments and other things. So what's really happened over the last few months is that we've kind of swapped out the word Japan and we've swapped in the word China. And this reflects a general shift in U.S. policy that was also there in the 1990s, as many in Washington began applying the same types of arguments to China as it began to integrate into the world economic system. The formula that the U.S. announced for tariffs on April 2nd was, I think, could best be described as a crude attempt to figure out what tariff rates we should implement in order to eliminate all of the U.S. bilateral imbalances. Now, I call the formula crude because whoever generated that formula failed to take into account the fact that higher U.S. tariffs would cause retaliation. Moreover, they underestimated the impact that higher input tariffs would have on import prices, trying to make the argument that these wouldn't be inflationary, that these wouldn't cost consumers and producers large amounts due to these fantastically high tariff rates. And lastly, they ignored the impact that higher parts prices would have on US firms that benefit from cheap imports. So when we raise tariffs on things like steel and aluminum, right, that has negative impacts on our car industry or our aircraft industry and other industries that need those inputs. Despite the embarrassingly poor execution of the policy, which I think it is possible to make a case that bilateral imbalances could, under certain circumstances, reflect barriers. But I think the evidence suggests that that link is weak at best. So around 25 years ago, I published a paper on what we call the mystery of the excess trade balances, which raised the question of why we observe these big bilateral imbalances. And the short answer is that we don't, or economists don't have a very clear model of what causes them. One factor involved is just the aggregate savings and investment balances of countries. So the US tends to run a trade deficit with the world, and that largely reflects the fact that many foreign countries want to invest in the United States because we have an excellent economy. But that doesn't really explain why it is that we run, say, persistent big trade imbalances or deficits with countries like with Canada and surpluses with places like Holland. Moreover, there seems to be very little evidence that tariff and non-tariff barriers are important in understanding the existence of these bilateral imbalances. And the administration seems to have a hard time understanding a third force that tends to lead to these imbalances, which is triangular trade. And that is the fact that countries systematically run deficits with certain suppliers and surpluses with others. And this has nothing to do with trade with tariffs or other types of non-tariff barriers. So, for example, the U.S., as I mentioned, runs a trade surplus with Holland. Holland runs a trade surplus with Canada, and Canada runs a trade surplus with us. And that pattern arises because Canada produces a lot more oil and gas than they can consume, so they ship it to the Western U.S. The U.S. pays for these imports by actually exporting a lot of Gulf crude oil and LNG to Holland. And then Holland, in turn, pays for those oil imports by exporting machinery to Canada. And that just simply reflects basic comparative advantage and has nothing to do with trade barriers. So just in conclusion, I think my bottom line is that it's hard to have much confidence in the administration's assertion that eliminating bilateral trade imbalances is a sensible economic policy. And to the extent that we think that there are unfair trading practices in some of our partners, a much more productive approach would be to engage in bilateral negotiations like we did with Japan in the Structural Impediments Initiative. And that diffused a lot of the tensions and opened up the Japanese market in a lot of important ways. So I'll stop here.
Great. Thanks, David, for starting us off so well. Jack, you've been a Treasury Secretary and then also an ambassador. So I think you're well suited to give us a sense of how you see the likely domestic and international effects of the administration's trade policy?
Thanks, Jeff, and thanks, David, for that terrific opening. I think domestically, it's almost unavoidable that the result will be higher consumer prices. Even in these last 24 hours, we've seen, a little tension developing between Amazon and the administration, because Amazon has said that it wants to post what share of the price increase is attributable to the tariffs, and the response of the administration has been that is something they would really very strongly prefer not happen. Now, I don't think that it's the same impact on all consumers. For a consumer who spends almost all of their income every month, the impact will be greatest. So that means the impact on moderate and low-income households will be higher as a percentage of the disposable income of the household than for upper-income households. I think that is going to be something that has a political consequence that's very real. Think of back to school or Christmas shopping, when people look at what they can buy and they can't buy what they expected based on very recent points of comparison. Just to put it into kind of very immediate context of where the economy was before the tariffs, we just got the inflation numbers for March, which showed March to be a month of moderating inflation. I don't think that is likely going to be what the April numbers show. So there'll be, news reports supporting what people experience at the stores, saying that prices are going up. Now, tends to be a one-time increase unless supply chains are adversely affected. There's every possibility that supply chains will be adversely affected. To the extent that countries have relied on doing business with the United States as something that was very predictable, reliable, based on the strongest system of rule of law and the absence of arbitrary changes, that's been kind of shaken in the last month. You saw it in the election in Canada just this week, where one of the main issues in the campaign, which flipped the outcome by a stunning almost 30% change in the vote, was that Canada can't depend on the United States the same way, certainly can't uniquely depend on the United States. I've heard that from counterparts in the Middle East. I've heard that from counterparts in Europe. So that means that we may see some lingering effect. I think it's going to be harder to analyze. It's going to take some of the work that the excellent economists on this panel do to unpack it over time. I think more importantly than the economic impact internationally is what it means for there to be a loss of confidence in the U.S. relationship. I think that what has happened in the last week is something that it may be irreversible, in the sense that there was a notion that there was a risk-free reliance on the U.S. dollar. I think there is now a risk calculation being put into what policies will the U.S. conduct that might create risk. What does that mean? That means that if you've got the opportunity to diversify your exposure to risk, foreign central banks may put less of their reserves in dollars. I don't think it's an on-off switch. I don't think you're going to see a rapid running away from the dollar, but I think it will, over time, be something that we see as a moment that reduce the reliance on the dollar. It's a special, unique benefit the U.S. has from having the dollar as the world's reserve currency, and it's almost impossible to predict what the timing or the scope of that impact is, but I think the direction is very likely that there will be more diversification. Frankly, the thing that is a limiting factor on that is there's no obvious alternative in terms of quantity or reliability. So it's not like all investors who would wish to diversify from the dollar can run to euros or Japanese bonds or Chinese bonds. There are different risk factors. What I'm suggesting is that it's now a different calculus from zero risk to risk that needs to be balanced against other risks. And that's something that only can work to the, I think, negative effect. last point I want to make has to do with the broader strategic posture of the United States. I think that the US economic dominance, the strength and depth of our markets, has been something that's really profoundly increased our ability to project US interests in the world. Even our ability to impose sanctions is dependent on the dollar being so central that other parties and other countries consider being cut off from dollar transactions as being something that they'll avoid and even modify sovereign policies to avoid. I think that we're going to see a diversification of exposure and an increase in optionality in terms of being able to avoid the US. And something that I focused on for years is that the plumbing has been built to do that really for 10 plus years. And what I'm going to be watching over the coming months, really the coming 18 months, 2 years, is how much movement we see along the spectrum to diversify away from the United States. I think that that will be something that is a factor in security as well as economic alliances. And we can get back and talk more about that later. The one kind of specific thing that I really do have to note before closing is that even if there's a moderating of tariffs against all countries other than China, I think we have to assume that the U.S. and China will remain in a pretty heated trade war for some time. The Senate will be voting on rolling back through a resolution of disapproval the 10% across the board tariff. I don't know if that will pass or not, but it reflects a broad concern about the impacts that I've described. The concern is deep in the farm country because our farm economy is very much an export-oriented sector. It's strong in consumer-oriented parts of the economy. I think the U.S.-China relationship is going to remain tense. I don't see China reversing its retaliatory measures quickly. I don't see the U.S. reversing its China-specific measures quickly. So the best scenario that I can see is that things improve vis-a-vis the rest of the world in coming months, but that as far as China goes, we're in for a long haul of a very tough relationship. And later on, we can get back to the overlap in the fiscal impact, which I think is very real.
Great, Jack. You covered an awful lot. We'll come back to, I hope we get a chance to come back to all of the issues that you raised. You ended in a way on China to some extent, and you've mentioned this. Teresa, much of your work has to do with the complexity of supply chains that have developed over the past 30 to 50 years in international trade, which in some ways has changed the way we have to think about international trade from the standard textbook models of, the mid 20th century, I think. So in that context, how do you think that current trade patterns and current trade policies will be affected by the great complexity of the supply chains that characterize international trade these days?
Great. Well, I think that's a great question. And just to build on what the prior two speakers have already discussed, I think one big word that needs to come out of all this and that it directly relates to supply chains is uncertainty. There is now a massive amount of uncertainty about what our tariffs are and what they will be. And so we now have this 10% tariff on everybody. As we just heard, perhaps Congress is going to work to remove that or not. Who knows? And then we also have the reciprocal tariffs that were paused for 90 days, but are still looming over firms. And so I think, and those reciprocal tariffs are enormous for some countries, think up 40, 50% for some countries. So I think that uncertainty makes it very hard for firms to make investment decisions. And in fact, to make some of the investment decisions that had been cited as a purpose for the tariffs in the first place, which was to, provide incentives for firms to open new manufacturing activity in the United States. So I think the uncertainty is number one. Number two, and David already mentioned about supply chains and inputs, I think that's relevant, but let me just pause first before we focus only on goods. I think also missing from the Trump policy and so far from much of what we've talked about is the fact that the administration's tariffs have focused solely on goods trade, okay, physical goods. And yet we know that for the US economy, services is much more important than goods trade. And in fact, that we are net exporters of services. And in fact, that because services trade is harder to measure, most economists estimate that we actually export a lot more services even than we can measure with our official statistics. And so why does that matter? Because coming back to these global supply chains and global value chains, one of the things I found in my work is that low wage, low cost manufacturing opportunities, I think, are highly complementary with a lot of the services that US firms do. And so let's just take some simple examples that everybody knows. I mean, Apple is a great example. That's not a US manufacturing firm. It doesn't actually manufacture in-house really anywhere in the world, but we know that Apple does a massive amount of design and innovation and marketing. And so what's going to happen to those activities in the United States if, the tariff on iPhones, I guess we're still waiting now also to hear what they're going to be on electronics. Again, the uncertainty, but if that tariff goes up a lot, then I think it's not only going to harm US consumers, who I agree with Secretary Liu are going to face much higher prices for goods, but it's also going to affect whether or not firms like Apple can continue to engage in the same type of innovation and work the activities that they've done before. So I think those are two really big things. I'm going to say on the inflationary side, in terms of who is affected, I agree it's likely to be these lower income households. And I will say even for another reason, which is if you look at which types of firms source from different countries, it's known that, Walmart sources a lot from China. The dollar store in particular, which has supposedly even lower prices than Walmart, disproportionately sources from China. And so lower income consumers who rely on those stores, I think, are going to be hit disproportionately hard already with the tariffs that are happening with China. And I agree that in a textbook case, once the tariff hits, it should be a one-time hit on price. But I think in practice, what's more likely to happen is that, in the beginning, some firms will say, well, we just can't send you this good at the price that, you're now willing to pay us. And then so some goods will stop. And then I think, in the shorter run, some firms will absorb losses. They may even be willing to absorb losses in their variable profits, but that's not sustainable. So I think over time, what will happen is you will have exit. And so I think that's going to keep that supply curve shifting left, which, remember everybody, Econ 101, when your supply curve shifts left, you have prices rise. So I think it's going to be very disruptive. The tariffs of the size of the reciprocal tariffs that are so big, firms don't have margins to absorb those. So I think you're going to see exit. I think on the stated goal, or as David pointed out, there's various different goals from different parts of the administration in terms of what was the purpose of the tariffs. In some cases, it's been to raise revenues. In some cases, it's been to foster US manufacturing. In some cases, it's been to negotiate deals. I think the goal to bring back US manufacturing is already going to completely be undermined by the uncertainty that we face in the tariffs. And then I think the second issue is the fact that if you look at US manufacturing now, those firms that account for the majority of US manufacturing sales, certainly innovation, those are multinationals. Okay, and those are firms that are producing not just in the United States, but they're producing around the world. And those firms account for the vast, like over 80% of our exports of goods. They are also importing. Okay, and they are importing, they're finding different inputs, different parts that they need to produce from different countries. Once they cannot source those inputs reliably and at low cost, my suspect that they're going to do things like, segment the US market from kind of the rest of the world. And so we're going to have fewer varieties here, and they will have higher prices, both of which David's work shows reduces welfare for consumers. And so I think that's what I would imagine if I was a firm, as long as the rest of the world is going to continue following the traditional rules we've had, let's build our global value chains, kind of excluding the US, and just have sort of separate niche production for US markets. And I guess finally, just to circle to this final point that I think is hugely important and probably the most important issue surrounding all of the different changes that we've seen in terms of how these tariffs have been announced and rolled out and changed is how does the US regain some form of credibility? Okay, so we have been a country that, has already been mentioned, we're the safe currency, reserve currency for lots of places. And I think that's because the US has been incredible in terms of having an average of about 2% growth per year for about 200 years. So it was a very, well-performing economy. And so investors are eager to own US assets because they have a kind of predictable return on the one hand. And on the second hand, we've also had very strong rule of law where you're not worried about the government expropriating your assets. You're not worried about a default. And so people have valued those two pillars, I would say, of the US economy. And a concern that I have is that now that we have reneged on so many trade agreements that we had, we've proposed reciprocal tariffs on countries with whom we have free trade agreements. In fact, the Trump administration itself had renegotiated the Canada, Mexico, US free trade agreement just a few years ago. And now they've gone and violated the terms of those agreements. And so it's hard to see how the current administration would be able to commit credibly to any new agreements. And so I think there really does call for a need for Congress to say, we are going to pass laws in which a single person or small group of people cannot upend a negotiation, so that businesses can know what are tariffs today, what are the expected tariffs today, and what is a future path that we can genuinely rely on in order to comfortably make millions and billions of dollars of investments over the long term.
Great, thank you, Teresa. As a great point of view from the realities of contemporary international trade that some people have not quite caught up with. Dennis, you're based in the United Kingdom in Warwick, which, Brexit or no Brexit, is still in Europe. So I'm curious, because Europe has been a target both of Trump, the first Trump administration, and more recently, more of a target given the reciprocal tariffs that are proposed. I thought it would be interesting to hear from you how the trade policy that has been discussed and to some extent implemented by the administration is being understood in Europe, in particular, abroad more generally, and how you think it will be responded to.
Yes, thanks, Jeff. So I will focus on the European Union for most of my remarks, but I'm very happy to talk about Brexit as well, because that might tell us a little bit about what's in store for us. Now, the headline EU assessment of the recent trade policy changes by the US administration is that it's a regime change. They see it as a structural break in transatlantic relations, economic relations in particular, that we've had over the last 70 or 80 years. The main issue of concern is the architecture of global trade. So far, this has been based on the World Trade Organization and arguably the rule of law. The system, could it survive if the US leaves the system? That is the big question that is being asked. And why do I say that the US might leave the system? Well, one of the founding principles of the World Trade Organization is equal treatment of foreign partners, called the most favored nation principle. You're supposed to extend the same tariff rates to all foreign partners. The reciprocal or so-called reciprocal tariff rates precisely do not do that. And the big question that people in Brussels and other European capitals are asking themselves is, can that system survive? Now, the WTO does allow for exemptions. In particular, Article 21 allows for the break of MFN rules under essential security interests. I'm not a lawyer, but the legality of the actions of by the US administration with regards to WTO law has been questioned. Now, that's the big headline. Specifically, what does the EU think is the economic impact on the EU? And I'd like to make 4 points here. The first is fairly obvious. Tariffs are bad news for EU exporters. The tariff rate so far, prior to the recent action between the US and the EU, has been about 1% on average in both directions. And now it's supposed to go up to 20% for EU exports to the United States. Now, the EU is also worried about the treatment of EU businesses operating in the United States. And Teresa mentioned global supply chains. For example, BMW has a big factory in Spartanburg, South Carolina. Airbus is in Mobile, Alabama. And they use a disproportionately high fraction of inputs, foreign imported inputs, that might be subject to tariffs. The second point is worries about escalation. This could go beyond tariff barriers. This could go to non-tariff barriers. And this is where Brexit is going to be crucial, because Brexit has involved 0 tariff barriers. It's all non-tariff barriers. And the uncertainty, again, that's a point that Teresa made, and also the legality of executive orders, with which comes the question of credibility. How do we know that these policies will remain in place? The third worry on the EU side is a recessionary risk and spillovers to other industries, including services. For example, we know that travel demand across the Atlantic is already softening, at least from the EU end. Consumer confidence is down, and that's something that European governments are worried about. And the fourth point is potential trade diversion from China. Now that it's become very difficult for Chinese exporters to send products to the US, some of them might end up in the EU, and that might put pressure on domestic producers in the European Union. What's the EU response? The EU has been unusually unified so far. In the short term, their strategy is wait and see. The expectation is that over the next few days and weeks, we will see the economic impact materializing in the United States. We already know that container influx from China to the west coast of the US is down, and prices are expected to rise, and so on. The EU, in principle, is very happy to negotiate. That's what they did under the first Trump administration. For example, there was a commitment to buy more oil and gas from the United States, and that's something the EU would be happy to do. But it's so far not entirely clear what to negotiate about and what the EU is supposed to do. In terms of the medium and long-term strategy, the EU wants to deepen its single market. So that means rely more on international trade within the European Union and not including the United States, and also deepen trade agreements or forge new trade relationships with other countries. For example, the Mercosur agreement with Argentina, Brazil, and so on, has been in the works for a long time, and now it's a much more favorable reception, especially by France, to get that through. Last but not least, I just want to say a few things about other countries. China, very briefly, my sense is the Chinese have made the judgment they can weather the storm. The Chinese government has been preparing for this moment for a long time, through the Belt and Road Initiative, but perhaps more importantly, on the finance side, they have set up their own Chinese payment systems that can rival SWIFT. So they think they can weather the storm. But let me finish on a completely different country, Lesotho in Southern Africa. It's a small country, has just over 2 million people, very poor. And they've been hit in 2 ways. So one, they've gotten a 50% reciprocal tariff rate. And that's one of the highest, partly because they have a big trade surplus with the US in terms of textiles and diamonds, including Levi's jeans. So that would hit them very, very hard. And the second is, well, they have a very high infection rate of HIV and AIDS, and have so far been very dependent on USAID. So new arrangements have to be found on that front. And we talk a lot about the US, we talk a lot about the EU, we talk a lot about China, but the rest of the world is even larger than that. So we probably need to pay a bit more attention to other countries. I'll leave it here.
Great. Thanks so much, Dennis. And I absolutely want to come back to both the Chinese response and where that might be going and the rest of the world. But I did want to explore an issue that Jack mentioned towards the end and related issues, which is there's been a lot of talk from the administration and others about the tariffs, which are, of course, a tax on imports, having a big positive revenue effect. Jack, why don't you take us through what you think of as being the fiscal impact of the new trade policies?
Thanks, Jeff. I think the different views in the administration make it hard to answer with certainty what the fiscal impact is going to be. But the thing that can't happen is you can't have temporary tariffs that are used as a way to pay for tax cuts, or else the tax cuts are going to cost you a lot of money and the deficit and the debt will go up. So how the question of the tariffs as a negotiating tool versus a source of revenue or even an offset for other fiscal policies is hugely important. Just to put it in the context of the fiscal debate that's going on, because it's not just a tariff policy. We're now in a month when the debate over the budget bill, reconciliation, and the tax bill are going to be in full gear. There's a tax bill that could cost as much as $5 or $6 trillion moving its way through Congress. If you think that tariffs could be $1 trillion of revenue, and then you negotiate them away, it's hugely consequential in terms of what the overall burden on the U.S. fiscal position is. I think that it's highly likely that a lot of the bilateral tariffs will be negotiated away. So I think it's highly risky to use those as a permanent funding source. But those decisions will be made in different policy arenas at different times. And the question of using it as a permanent revenue source brings into question whether there ever will be a return to more normal trading relations. So it's highly consequential in terms of what the picture is for the future of U.S. Trade relations with all of its trading partners. I think that if you put it in the context of the kind of outlook for the U.S. fiscal position, before the tariff policy was announced, Moody's did a report on the United States where it said under its most favorable forecast, it only saw a deterioration of the U.S. fiscal position. I think what we have to assume is that these tariffs will be, to some extent, a short-term benefit. More likely, it will be either a wash or a long-term cost because the policies will be changed. Final point on the fiscal impact. Back in the first Trump administration, when there was a tariff policy, the burden it put on the U.S. agricultural sector was so strong that there was increased spending that I may have the number a little wrong, and David Weinstein may know the exact number. Roughly half of the tariff revenue was used to soften the impact on the farm sector. So I don't think we've seen the last of the need to spend money to offset the impact of these tariffs on specific sectors. So I think it's highly unlikely it will do anything material to improve the U.S. fiscal outlook. I think there's a very high probability that either because the money is spent and then it doesn't materialize, or because the burden will have to be offset, that it actually causes a deterioration in the U.S. fiscal outlook.
Thanks for that, Jack. David, go ahead. I know you've thought about this.
Sure, yeah. So I've been running some of the numbers on the tariffs that have been announced. And it's a bit of a tricky thing because, as Teresa mentioned, these things are changing day to day, sometimes within a day. But if you look at where the tariff rates that have been announced as of a few days ago, One of the striking things when we run our simulations is how little extra revenue you're generating or we're going to generate. And that's largely because a lot of the tariffs have become prohibitive. That is, you're just not going to see any imports coming in. We've already seen fairly substantial shifts away from China to other countries, and that's just going to continue. So in our estimates, we're really close to a point at which higher tariffs will not have any additional revenues. And if we go to the maximal tariffs, the ones that were announced on April 2nd, we're actually going to start to see tariff revenues going down. Republicans used to be very enamored with the Laffer curve. It's a bit ironic that we're now in a world in which we're applying taxes on trade that are so high that we're reducing revenues by increasing our tax rates. So again, I basically agree with what Jacka was saying, is that this is not a policy that's going to be a particularly effective source of revenues, especially in worst case scenarios.
Yeah. And just to reinforce one of the points, which has to do with some of the contradictory nature of the policies, if you use the tariffs as a bargaining chip, that means you're planning to take them off if you win your bargain. And that means they don't play any role in protecting American industry. So the one goal of using tariffs to reshore American industry is inconsistent with the goal of using tariffs as a bargaining chip. Teresa, go ahead. I know you've thought about this as well.
Yeah, I would say, just to do a full circle on some of the internal inconsistencies, the formula that was used to calculate the reciprocal tariffs, as David noted, there were a number of assumptions that are clearly violated in practice underpinning that formula. But even that formula was all about how big of a tariff do we need to reduce imports from each country such that we have balanced trade with them. So we're therefore planning to reduce imports, and yet I think many of the calculations the administration had done on what would the tariff revenue be assumed imports stayed the same and applied the tariff rate to the same flows. So, that was not an internally consistent across the different goals way of calculating that. I want to just take a step back and make 2 points, because I do want to say, I do think it's important for us as trade economists to acknowledge that there is a lot of work in international trade saying that there is what we like to call a terms of trade motive for a tariff. And what is that? That's saying, well, we're a big country, so if we buy a lot of a good and we put a tax on that good, that is going to be partially borne. Some of that tax will be borne by the foreign firms. Okay, and there's lots of people who have studied this and argued that it, in a world in which countries cannot agree multilaterally, cannot come up with trade agreements, that you might want to have a tariff. And I think the 10% tariff that the administration put on everybody and everything, would have achieved some of that. I think that for some goods in some countries, foreigners would have borne some of the cost of that 10% tariff. I think that tariffs of the size that we're talking about with the reciprocal tariffs, and certainly tariffs of the size that we have with China, there's just no state of the world in which firms have margins that are that big that they're going to be able to absorb anything close to, most of the tariff. So I think they're exactly what David said is right. And I'm going to say, in terms of the fiscal impact, I think what we really have to take into consideration here is that these tariffs are highly distortionary, both for consumption and for production. And all the evidence that people who like to study firm level data, that's what I do. I look at, at the individual firm establishment level, like across the whole country, what happens. And there's been really good evidence over the last 20 years that every time countries liberalize, you get big productivity gains. Okay. And you get these productivity gains for 2 reasons. One is that we have what we call a selection effect. So activity shifts towards the more productive firms. Okay, those are the guys that get rewarded. They can compete with the foreign firms. They grow. Our aggregate productivity in the country rises. You also get within firm productivity gains, okay, because firms actually make changes by adopting new technologies, by introducing new products in order to either escape competition, or also, if it's a bilateral liberalization, then to access new markets. And so I think that we're going to have big negative growth effects from these tariffs. Okay, so I think US productivity will fall, and I think that growth will decline. And I actually think that's going to happen some in the short run, but it's going to be worse in the long run if we persist with this regime. Okay, and both of those things are going to make it harder for us to be fiscally solvent. And I think this kind of circles back to what we talked about in the very beginning, which it seems like a goal of the administration is to have a balanced trade, no trade deficit, right? Balanced trade. And they've focused on it with individual countries, but we've talked about why that really doesn't make sense in a world with global value chains, or even in a world without them. You could still have balanced trade across all the different countries, even if you had surpluses with some and deficits with others. But I think actually that our focus on having a, no current account deficit and blaming imports of goods from other countries on the current account deficit is exactly getting it wrong. It's getting it backwards. So I think our current account deficit is intimately linked to our fiscal deficit. And as we were just discussing, we have a big fiscal deficit. We spend a lot more, right? Consume and invest a lot more than we save. And right now, up until April 1st, foreign countries had been willing to lend to us because of what I talked about before. The US economy grows well, and it's a safe asset. And we've seen that willingness to invest seems to be declining. I agree with Secretary Liu, like it's not, going to be a hard stop, but it seems like there's going to be less of a willingness to lend to us. And I think that is going to force the US to face the fiscal deficit we have, which is nothing to do with, China manufacturing goods cheaply. That comes from how much do we make, how much do we consume, how much do we save, how much do we invest? And so I think if that 10% tariff on everybody was the only politically feasible way to put a consumption tax on Americans in order to balance our budget, maybe that could have actually worked. But instead, it seems like it was accompanied by these hugely distortionary taxes.
Great, thank you, Teresa. And I appreciate the notion about the impact of open international trade, or globalization, as it's sometimes called, on productivity increases. I want to build on it because we got a lot of questions from the audience, the prospective audience, about its impact on the rest of the world, and in particular on developing countries. Dennis, you mentioned Lesotho. I think the context is that I think most people would agree that many countries in the developing world have benefited tremendously by opening to the world economy, getting access to the world's markets and capital and technology and ideas. We've seen billions of people lifted out of poverty in this process. This seems like a very serious challenge to developing countries that have come to rely on the United States and other developed countries for an open trading system. I guess the questions that have come from the audience are, what are the options available to developing countries and others? Can the WTO be used to try to counteract what's happening with American trade policy? Is there some prospect of a new trading system developing in which the United States is not playing a major role? How do you see this playing out for developing countries around the world, Dennis?
Well, the first thing to say is you have to look at the details of different countries, because not everybody is exposed to the United States as much as maybe people sometimes in the US tend to believe. I made this point in Europe. Ireland, more than 50% of their exports go to the US. Cyprus, only 2%. Right? Same is true for developing economies. A lot of African economies actually export a small amount only to the United States. Lesotho is in some extent actually a big exception. Now, what happens to them to the extent that are trading with the United States, it's very hard to compensate that loss in the short term. But let's not forget, other countries, China in particular, are standing ready. And they've been anticipating that moment for decades now. I mentioned the Belt and Road Initiative earlier. Essentially, all of Africa is part of it very heavily. Most of Southeast Asia is part of it very heavily. If you think about the previous US strategy with the Pacific pivot, TPP, the Trans-Pacific Partnership that was being hashed out under President Obama, was all about isolating China. And then, of course, that never happened. Oh, the US withdrew from that and it became an Asian agreement. Now, that is what's going to happen in those economies in Southeast Asia. They're going to reorientate towards China in particular. I know that in the European Union, this is a very active point of discussion. They are thinking very hard about forming and forging new trade relationships. So to cut it short, in the short term might be very painful, but in the medium to long term, countries are going to reorient away from the United States. And let me just add one other point. We're talking about tariffs here. In some sense, businesses love tariffs. And let me explain what I mean by that. It sounds a bit weird. What they like about it is the transparency. A lot of business saying, give me a 10% tariff, I'll take it any day. But if you start messing with me by imposing regulation or technical barriers to trade or other non-tariff stuff, they do not like that. They can't calculate that. There's so much more uncertainty about it. They're deeply worried about lack of transparency. So we're talking about a lot of uncertainty now in the context of tariffs. But if this escalates to other trade barriers, it might be potentially much worse. And this is where the Brexit experience will be crucial. The initial estimates of Brexit, the impact of Brexit, were, even on the pessimistic side, too optimistic. And what we've learned over the last few years, even the pessimistic scenarios were not pessimistic enough. And the reason is that it's not just all about trade. There are all these other issues that come in at the same time that tend to be complementary, like FDI, like exchange rate depreciations, like consumer prices, more macro factors. The trade people are sometimes quite narrowly focused on trade. But if you take the full picture into account, you tend to get a worse impact. And to the extent that the UK experience is of any guidance for the US experience, that is something we should watch out for.
Great. Thanks, Jack.
Yeah, I just wanted to add one other point on China, because I agree with the point that Dennis made. China has been working really since 2013 to build the system for increasing its role in the world through the Belt and Road Initiative. The experience China has had in a lot of these countries, I did a study on this about 3 years ago, was they were succeeding largely where there was no alternative, not because they were the first choice. I think that this tariff policy has created a world where not only is there not a better choice, but where the US has said you can rely less on our being there now and in the future because we're not as reliable as we used to be. I think if you were looking for a way to create an advantage for China in accomplishing its goal, this tariff policy is exactly that. Now, where I think the saving issue may be is China's own practices. The reason that countries have had second thoughts about Belt and Road Initiative is it hasn't worked out that well for them in a lot of cases, either financially or in terms of the impact on their economies. But it's not great whether it's the use of the dollar as the world's reserve currency or your competition with your principal adversary in the world for your success to be hinged on their failure. And I think this has created an opening where the question is, can they capitalize on it because the opportunity has been created?
Thanks, Jack. I think that's a really important point that I don't think we're going to have time to explore in greater detail, but the notion that in some sense the American policies may be creating an opening for China in both the developing world and with other countries around the world is a really important one as we think of this not only in the economic context, but in the broader international and national security context. I think there's been some discussion, and we had some questions from the audience about the possibility of a EU-China axis forming as a sort of alternative to the US maintaining the WTO in some form or other. I don't think we would need to speculate on that. But I think that those who are thinking about the possible implications of American policy should keep in mind that the fact that the United States seems to be abandoning some of its multilateral commitments doesn't mean that the rest of the world has suddenly become protectionist. It principally means that much of the rest of the world is now concerned about protecting themselves from the United States, which is new for many of them. But I want to pivot, as they say, to a different question that came from the audience, actually a series of questions that I think Teresa is particularly well suited to address. So these were two interrelated questions. One was, well, I'm curious about the impact of the tariffs on different kinds of firms. Like there are big multinational firms in the US, and then there's small and medium enterprises. And we know small and medium enterprises create most of the jobs in America. And so what's the effect going to be of the tariff? This is from someone in the audience, maybe from a small and medium enterprise entrepreneur. What is the differential effect of the trade policy expected to be on big as opposed to small and medium enterprises? And how does that translate into either job creation or job costs? Teresa.
Okay, so just to clarify, why was I shaking my head? There's actually a really interesting paper that looks at both firm size and age. And it's actually really the young firms that create jobs, not necessarily the small firms. And I just think here, you know, when Amazon or Google were starting out, they were young and small. They grew like crazy, but you have many, many small firms like dry cleaners, and those are not the ones that are, you know, kind of driving our job creation. So I do think this is a really good question. I think it's not so easy to answer. I'm not sure that there's a direct answer. Let me tell you in three parts. So certainly when we looked, or in the research I've done looking at when China first joined the WTO, and we did lose certain manufacturing jobs, especially in areas that were concentrated and those goods that China got really good at making and selling here, it tended to be the big firms that lost more employment, okay? And so you saw that. Now, what I also though saw in some of my work was that those guys were often shutting down some of their big labor-intensive plants, but they weren't necessarily exiting. And so those big firms also started changing what they did. And so let's just take examples from that we know from publicly available data, like Apple and IBM. You know, in 2004, they both shed all their personal manufacturing or personal computer manufacturing. And, you know, we got Lenovo and Apple started outsourcing to Foxconn, but they still grew. They just changed what they did in the United States. And so I think those big firms also have kind of that capability to adapt and pivot. Now, if you were one of the manufacturing workers at those firms, you may not care, right, that they pivoted. It may have just been a negative shock for you. But the firms themselves, I think there's really big creative firms that were innovation intensive benefited and were able to do a lot more of the innovation and, again, types of activities that we tend to think lead to more growth. I would say that in this situation, because it's a little bit the reverse and also all the uncertainty, I think, you know, some of the big firms have enough money sitting around. You know, think about Apple, think about these big tech firms. I mean, they're very profitable. They're going to have the resources probably to weather the storm and potentially change how they do things as policy changes. I think the smaller firms that rely on imported inputs directly, those guys may just fail. And I think that even those firms that don't rely on the direct imported inputs are likely to see the prices for their inputs go up a lot in ways that may also either lead them to contract or potentially fail. So I think if you're a smaller firm that doesn't have the resources to weather the storm, then I do expect to see exit. And then I'm going to say one other thing, which I think is really hard to measure, but I'm very interested in these kind of US firms. We call them factoryless goods producers. So they're firms that manufacture, but without having actual manufacturing in the United States. And it's actually really prevalent. I mean, Apple is an example, but so are a lot of the US bike manufacturing firms. They design, they market, they do all that. And I actually think there's a lot of small US firms that do that. And now that they won't be able to get cheap things from China, they may not even enter at all or exist at all.
Great. Well, unfortunately, we're just about out of time. This has been, I think, a really fascinating discussion. I hope it is the first of many about the implications of the changes in American trade policy. I think we can all agree that however we would summarize the current situation, we live in a time of great uncertainty. I think there is a concern that all of us have expressed, and I think an appropriate one, that there may have been and may be a loss of confidence in the credibility of the commitments of the United States, something which would have an impact not only on the ability of the United States to negotiate trade agreements with other countries, but also on the role of the dollar internationally, and perhaps even more generally, as Secretary Liu pointed out, on America's national security concerns and its ability to maintain its national security with its traditional allies. Specifically, with respect to trade, the policies that have been discussed, taking into account that there are some internal contradictions between the goal of reindustrialization, of revenue, and of using tariffs as a bargaining chip, these trade policies raise a whole host of questions. Now, we don't know where they're going. The courts may chime in. They aren't being asked to. Congress may chime in. The voters may chime in 2026, and public opinion may have an impact on where trade policy goes. But I think that all of us, I believe, would agree that whatever happens over the next few years, the international economic order and the international trading system are unlikely to ever be the same in ways that we cannot entirely predict. The role of the US in the world economy and in international trade has changed fundamentally. And I thank you all for helping us understand where we have been and where we may be going. And I hope that we can do this again sometime to shed even more light on the subject.
Thank you, Jeff.
Thanks, Jeff.